All right, we're going to look at a trade that I put on earlier today before the market closed, but I did not get a chance to put this trade out. Couple of reasons. Number one, once the trade filled, I realized that I kind of screwed the trade up, but but I think this trade is going to be okay, and I am just going to have to play the hand that I'm dealt to the best of my ability. And I'm going to set up this trade just to show you what it looks like. And um, I think what I want to convey here is that sometimes when you enter a trade, unless you completely screw things up, like instead of calls, you do puts, instead of buying, you do the selling, that is that's kind of hard to play that hand if you're dealt. So you're going to try to maybe undo the trade and escape, taking a beating. But if you did something like what I did, and I'm going to show you what I did in a second, I think we can still make this trade work. So what I'm going to do is I'm going to model this as a trade in ES. I'm going to start a new trade. And once again, it's kind of hard to tell the exact expiration other than looking at the days until expiration. So I'm looking at 113 days, and that is May 31st. So it's end of the month, May, expiration cycle. And what I did was I set up a 112, and my intention was to set up a trade that looks like this. All right. Let's see. The long put debit spread is at 48.50. So let's go ahead and model that. I'm long one, 48.50 put. I am short one, 4,800 put. That's my put debit spread, which is about just over 4% out of the money. And then I meant to sell two of the 4,000 puts. 4,000 puts are about 20% out of the money. And what I ended up doing by mistake, I sold one $4,000 put, and then I sold one 39.50 put. So my 112, the two is kind of a um, not on the same strike, but it's spread between two strikes that are next to one another. So I am long a put debit spread, which is about 5% out of the money, and I am short naked puts that are, let's call this 20% out of the money. And this trade is 113 days until expiration. Right now, this trade is currently going for $10.70. I filled this trade earlier today during regular trading hours for $11 credit. So, um, this is the trade that I actually filled, and this is the trade that I wanted to do originally. So instead of selling one 4,000 put, I meant to sell two. So if you wanted to do something similar to that, you can look at this trade, and that is currently going for $11.50. So now we know that 1150, obviously with ES being a 50 multiple, it's just half of the premium that we're actually collecting. So we're not collecting $1,100 here. We're collecting half of that. So 575 is our trap profit. We have a potential $2,500 gain inside of the trap. Right, so 2,500 plus the 575. So let's round this off to about $3,000. So in the trap, I'll make 3 grand. Outside of the trap, I'm going to make just shy of 600 bucks. And my stop loss in this trade is going to be a loss of about $6,000. So I'm sorry, not 6,000, about 3,000, 3,000, 3,100, 3,200, something like that. Right. So I don't want to lose a lot more than what I stand to make. If everything goes right and this trade is perfect and will land somewhere inside of the bear trap in 113 days, right? The most this trade could make is, let's call this 3,000. So my stop is going to be at a loss of about $3,000. And we can look right now, right? This $3,000 loss will be somewhere around ES at 45.50, maybe 45.60, right? At 45.60, you can see my P&L today is showing a loss of about $2,935, assuming that volatility will rise if the underlying is going to pull back. So I do have about, let's call this between 8 and 9% downside cushion before this trade has to be removed. So that's the idea. I'm going to add this trade. I'm going to book this trade into Optionet Explorer the same exact way that I got filled. So I'm not going to do 2 puts at 4,000. I'm going to do short 1 put at 4,000, short 1 more put at 39.50. This trade I filled for $11. So 550 is my tail profit. Inside of the trap, it's 2,500 plus 550, so about 3,000. And my stop is at any time this trade is down 3 grand, it's time to take this trade off and move on to the next trade. So my stop is going to be somewhere around 45.50. Maybe I will make an adjustment only because the T plus 0 line is pointing lower and it's starting to really dive before or right as we enter into the trap. So if we hit the trap today, right, S&P at 4,800, which is technically nothing wrong with this trade, but because there's so much time, right, our T plus 0 is really pointing lower here and it starts to really slope downwards. So at 4,800, I'm going to be down about $850, given that volatility might rise if the underlying is down about 4%. So maybe I'm down $1,000, which will be about 1/3 to my stop. So if we get there fast enough, I may consider putting in some kind of a hedge to remove some of that directional risk, even though with the ES contract and only doing a 1 contract or a 1 lot for this trade, you can see that at 4,800, my delta is going to be about +5. So if I wanted to remove this delta, I would have to try to figure out, maybe I'll bring in some sort of a put debit spread that will give me a net negative delta of 5. So I will totally neutralize my position to kind of put in a speed bump, if you will, right? Just to slow things down a little bit on the downside to see if the market is just going to pull back and then come back up. Or if things get really, really serious and the market continues to trade lower, that put debit spread that I'm looking to bring in as a hedge is going to kind of help me hold this trade a little bit longer and maybe delay my stop out. So that's the idea. I am going to put this into Optionet Explorer. My put debit spread is at 48.50, 4,800. And the short naked puts are 1 put is at 4,000, 1 put is at 39.50.